Hello, and welcome to the Geopolitics Explained podcast. Last week, we explored the important policies that came out of the UK budget. I then started to discuss how UK politics is currently limited by its financial reality. It's today's episode in which we're going to explore this financial reality and the details of these limitations. We will then discuss if the UK can navigate this environment, and if it can, what will be required for this situation to be resolved. So, to begin, let's dive into the characteristics of the UK's financial reality. The UK finds itself in a tough situation financially, and in large part, it's driven by a lack of confidence. Ever since the budget in 2022 and the Liz Truss fiasco, each budget since has been formulated with stability as its main priority. As Bill Blaine often discusses, the virtuous sovereign trinity is a three-legged stool of effective politics, a stable currency, and efficient bond markets. When Truss introduced the 2022 budget that included unfunded tax cuts and large spending, a dramatic loss of confidence emerged in bond markets because this increased spending would have had to come from more borrowing. This was criticised as fiscally irresponsible. Truss had also bypassed the Office for Budget Responsibility, and inflation remained heavily elevated at the time of the budget. This dramatic spending increase could have fueled further inflation, and this amplified the risks even further. In response to rising inflation, interest rates would have increased. This would have led to larger interest payments on debt at a time when, if this budget went ahead, borrowing would have been skyrocketing. On the flip side, if interest rates weren't raised while inflation did remain elevated, then we would have seen the UK enter into an environment of fiscal dominance. The lack of fiscal responsibility as a part of this 2022 budget saw confidence fall dramatically, and holders of UK bonds started to sell. This led to bond prices falling and bond yields rising due to their inverse relationship. The dramatic fall in bond prices saw pension funds experience losses on their bond holdings. As a result, the Bank of England had to intervene and purchase UK bonds to prevent the system from collapsing. The British pound also fell to historic lows against the US dollar. So, it was the Liz Truss budget that led to chaos in the bond markets. This then contributed to unstable politics and a collapsing currency. The three-legged stool of the virtuous sovereign trinity had very clearly collapsed. As a result of its collapse, the stool needs stabilising. This came with Truss's resignation and with the intervention in the bond markets from the Bank of England. But since then, there's been a lack of confidence that has been baked into UK debt markets. This has kept bond yields elevated in what has become known as the moron premium. With this low confidence, the aim in every UK budget since the 2022 autumn budget has been to keep the stool intact. Any slip up in the budget could lead to a collapse of the three-legged stool once again. As a result of this lack of confidence and the need for stability, this limits what the UK can do in these budgets. So, can they escape from this situation of low confidence, or is this a situation in which the UK is trapped? Well, the current Labour government is attempting to escape from this current situation. In an aim to incite more confidence in UK debt markets, Labour has presented two fiscal rules in their manifesto that they promise they will adhere to. The first rule is that the current budget must move into balance, ensuring that day-to-day spending is met by revenues by 2029. The UK currently has a fiscal deficit. This means that it spends more than it makes. The aim by the end of this Labour government is to turn this fiscal deficit into a fiscal surplus. The second rule is that public sector net financial liabilities must be falling as a proportion of gross domestic product by the end of the current government. Public sector net financial liabilities are a broad measure of what the government owes. So, in general, the aim is that spending will be met by revenues and UK debt will fall as a percentage of the size of the economy. Are these fiscal rules achievable? And if they are, how will they be achieved? We'll first discuss moving from a fiscal deficit to a fiscal surplus. In undertaking this, there are two main options. The first option is to reduce spending. This was the austerity approach that was taken by the Conservatives. It saw investment in public services fall, and this is now indicative in the stagnant and declining quality of many public services in the UK. The current Labour government is trying to increase spending to improve public services. But increasing spending in isolation worsens the fiscal deficit. As a result, this has to be balanced by the second option to move from a fiscal deficit to a fiscal surplus, and that is by increasing revenues. Increasing revenues can come from higher productivity growth or higher taxation. From the budget that we saw a few weeks ago, the Office of Budget Responsibility downgraded productivity in the UK. As a result, increased revenues will have to come from higher taxation, and that's what we also saw in this recent budget, as the tax thresholds were frozen for a further 3 years. This occurred despite Labour stating that they wouldn't raise taxes on working people in their manifesto, and this ultimately reduces the money in people's pockets. So, the first rule is about balancing between spending and revenues. Since Labour is opting to spend, they will have to increase revenues at a faster pace than they are spending. This is the more difficult option because it requires a large amount of tweaking if unforeseen circumstances arise. This is where Labour's headroom in their budget comes into the discussion, and that's why it's so important. If this headroom gets too small, it gives them a lack of wiggle room, and then they will have to make dramatic changes to this current plan. As I've alluded to, since these increased revenues look unlikely to come from higher productivity growth, especially in the short term, this will come from higher taxation. In Friday's episode, we will discuss if the UK can find productivity and economic growth anywhere, which would reduce the likelihood of future tax rises. But for today, we'll continue to explore these two rules and we'll assume that Labour will have to pursue higher taxation in order to meet these rules. Now, diving into the second of Labour's fiscal rules, Rule 2 essentially describes Labour's efforts to reduce the size of the UK debt in relation to the size of the UK economy. There are also a few ways that this can be done. Firstly, if the economy is growing, then the economy has to grow faster than the rate at which debt is growing. This reduces the overall debt burden. This becomes a problem if the economy isn't growing. In Q3 2025, the UK experienced a 0.1% growth rate in comparison to Q2 2025. So the UK is currently in an environment of low productivity and low economic growth. As a result, the UK has to pursue the second option to reduce the size of the UK's debt. This occurs by reducing borrowing. Now, this is connected to interest rates and also to the low confidence in the bond market. Interest rates currently sit at 4%. This means that the UK pays more interest on its current debt holdings than if interest rates were lower, as they have been in years prior. But we also see inflation remain elevated in the UK at 3.6%. Typically, when trying to reduce inflation, interest rates are elevated. The Office of Budget Responsibility expects that inflation will fall over the coming years, but today the UK is paying a larger amount of interest on its debt in this environment, and this could drag out for a few more years. This environment ultimately makes the debt situation in the UK worse, not better. This has seen interest payments on UK debt double since 2020, and the OBR expects that total interest paid on debt will be around £111.2 billion this year. This relates to 8.3% of total public spending. This is why the UK needs to maintain bond market confidence. If they don't, then bondholders will sell and bond yields will rise to compensate. This raises the cost of borrowing, and this hinders the UK in its attempts to reduce its current debt burden. But reduced borrowing isn't a financial tool that can be used in isolation. It is a consequence of a fiscal surplus. Because if a nation has higher revenues and higher spending, then it doesn't need to borrow to bridge the gap between revenues and spending that occurs in a fiscal deficit. As a result, the fiscal surplus that Labour wants to achieve from its first rule is a necessity for it to reach Rule 2, where it wants to reduce the overall debt burden. As we discussed earlier, a fiscal surplus requires higher revenues or lower spending. Labour is still spending, and so they need to make higher revenues. Because this isn't currently coming from economic growth and productivity gains, it will likely have to come from tax rises if economic growth or productivity gains can't be found. If these gains can't be found, the key question in coming years will be where these new taxes will be directed and by how much will they be raised. Prior to the budget that we saw a few weeks ago, many expected that one of the big taxes, such as income tax, national insurance, or VAT, would be the one that would rise. Instead, the Chancellor opted for a more focused approach, implementing smaller changes to capital gains tax, dividends tax, and closing tax loopholes, among other strategies. Individually, these make less of an impact, but the hope is that together they add up to meaningful change. If this meaningful change to increase revenues doesn't occur, and if the UK can't find economic growth, even higher taxes in the UK could be used to increase revenues so the government can meet their non-negotiable fiscal rules. This leads to the discussion that we'll dive into next time, in which we'll explore whether there are any areas where the UK can increase productivity, or if higher taxes are inevitable. That's all for today. If you enjoyed this episode, why not leave a review on the podcast platform of your choice? It really helps out the podcast. I've been Dylan, and I'll talk to you next time.